Hello and welcome to Sense Business YouTube channel. Today we will be covering 5.5 Analysis of Accounts. Today's lesson's outcome is that we will understand profitability. We'll understand the concept and importance of profitability. We will also understand liquidity, and we will understand the concept and importance of liquidity, and we will also cover ratios involved in both profitability and liquidity, like gross profit margin, return on capital, current ratio, asset test ratio. We will cover this, and we'll also cover who and why people use accounts and who are the main users, external and internal. We will also cover some limitations of accounts. Okay, great stuff. So to begin this lesson, I want you to understand what analysis of accounts is. So account analysis occurs whenever a financial transaction or statement is broken into component parts and examined in detail, either to gather information or gain a better understanding of what it is or has taken place. So that's what analysis of accounts is. Most analyses focus on identifying trends, evaluating how well the business is performing, and pinpointing unusual or suspicious transactions. So the ability to conduct in-depth account analysis is a basic skill every small business owner should carefully develop. And that is why analysis of account is important, and that's what the definition is. So what is ratio analysis, you might be thinking? A ratio analysis is a quantitative analysis of information contained in a company's financial statement. So ratio analysis is used to evaluate various aspects of a company's operating and financial performance, such as its efficiency, liquidity, and profitability. So analysis is looking into it and going into great detail. So the ratios we'll be covering are profitability and liquidity. That's what we'll be covering in this lesson. So what I've put a link to my website here, www.sensebusiness.co.uk. There's plenty of resources in this website. Make sure that you definitely visit it. The link will be in description below, or you can just type into Google Sense Business Studies and my website will pop up #1 on the Google search. Okay, so the concept and importance of profitability. So profitability ratios are used to determine the company's bottom line and its return to investors. So that's what profitability is, and that's why it is so important. Profitability measures are important to company managers and owners alike. If a small business has outside investors who have put their own money into the company, the primary owner certainly has to show profitability to these equity investors. If they don't, then there's going to be a conflict between the investors and the owner, and it's very likely that the investors will take their money and go and invest it somewhere else if the owners don't show profitability to these equities. So profitability ratio shows a company's overall efficiency and performance, and that's what makes it very important. So profitability ratios, these are ratios are used to see how profitable the business has been in the year that's just gone past. So the profitability ratio shows how well a business did last year. So because it has all the information in there, there's 3 formulas that we can use to see these information. So return on capital employed, gross profit margin, and net profit margin. You need to remember these for your exam. So profitability ratios are return on capital employed, gross profit margin, net profit margin. We will explain each in a bit more detail so that we understand what each is. So return on capital employed is also known as ROCE, is a profitability ratio that measures how efficiently a company can generate profit from its capital employed by comparing net operating profit to capital employed. So in other words, it means return on capital employed shows investors how many pounds in profit each pound of capital employed generates. So let's say this formula will show an investor, if they invest £1, how much will the return be on that £1? So if they put £1 in a business, is return on capital is good and is stable, and they get a 10%, or for each pound they put in they get £1.50. So that's what return on capital employed is, and the formula for that is that return on capital employed equals net operating profit divided by capital employed. This is the formula that you'll need to remember for the exam. So return on capital employed equals net operating profit divided by employed capital. Sometimes in exam you might not be given the capital employed. So if employed capital is not given in an exam, you can calculate it by subtracting current liabilities from total asset. So in an exam you might be given the current liabilities and total assets, but you might not be given employed capital. So what you can do is, it's the same principle, you use the same formula, but you use total assets take away current liabilities and it will give you the same answer. So if you're not given employed capital, then you will need to look for total assets and current liabilities and take away that from total assets. So return on capital employed is a long-term profitability ratio because it shows how effectively assets are performing while taking into consideration long-term financing. So return on capital employed shows net profit earned on each unit of capital employed. The higher the return on capital employed, the better the profitability for the business and investors. So capital is money, you know that. Okay, so gross profit margin. Gross profit margin is a measure of profitability where it shows the percentage of revenue that exceeds the costs of goods sold. It illustrates how successful a company's executive management team is in generating revenue from the costs that are involved in producing their products and services. So in short, the higher the number, the more efficient management is in generating profit for every pound of labor cost involved. So the formula for gross profit margin is that the revenue take away cost of goods sold divided by revenue times 100. You will need to remember this for exam because it's very likely that you will be asked to work this out. And that brings us to net profit margin. So net profit margin is the percentage of revenue remaining after all operating expenses, interest, taxes, and preferred stock dividends, but not common stock dividends, have been deducted from a company's total revenue. So the formula for net profit margin is net income divided by total sale is net profit margin. So you will need to remember this formula for your exam. So net profit margin is net income divided by total sales. It will give us our net profit margin. Now this is going to take us to liquidity ratios. So liquidity ratios shows us the ability of the company to pay back its short-term debts. So if a business doesn't have the necessary working capital to do so, it will go into illiquid, meaning they will be forced to pay off its debt by selling their assets. We covered what assets are in an earlier video, so if you're not sure, make sure you watch that. So there are two liquidity ratios, and they are called current ratio and liquid ratio, also called asset test ratio. Sorry, my battery is nearly run out. Okay, so current ratio, this is the basic liquidity ratio that calculates how many current assets are there in proportion to every current liability. So the higher the current ratio, the better it is. The formula is current ratio equals current assets divided by current liability. You need to remember that the outcome needs to be above 1 to be successful, or it's to show that you are doing well in the market that you are in. So liquid ratio or asset test ratio. This is a very similar to current ratio, but this ratio doesn't consider inventory to be a liquid asset, since it takes time for it to be sold and made into cash. So a higher level of inventory in a business can thus cause a bigger difference between the current and liquidity ratio. So the formula for liquid ratio or asset test ratio is asset test ratio equals current assets take away inventories divided by current liabilities. Okay, so now let's talk about the users of accounts. So we have internal and external users. So first we will cover internal. So internal users of accounts are your managers. So managers will use accounts for analyzing the organization's performance and position and taking appropriate measures to improve the company's results. So employees, so for assessing company's profitability and its consequences on their future payment and job security. So owners and shareholders, they will use accounts for analyzing the viability and profitability of their investment and determining any future course of action. So the external users are like creditors, tax authorities, investors, customers. These are your external accounts users. So creditors will use it for determining the credit worthiness of the organization. So terms of credit are set by creditors according to the assessment of their customers' financial health. So creditors include suppliers as well as lenders of finance such as bank. So tax authorities for determining the credibility of tax returns filed on behalf of the company. Investors will use the accounts for analyzing the feasibility of investing in the company. Investors want to make sure they can earn a reasonable return on their investment before they commit any financial resources to the company. Customers, so for assessing the financial position of its suppliers, which is necessary for them to maintain a stable source of supply in the long term. So these are your internal and external users of accounts. So limitation of using accounts in ratio analysis. So ratios are based on past accounting data and will not indicate how the business will perform in the future. Internal users will have all accounts, but external users will only have those published accounts that contain only the data required by law. so they may not get the full picture about the business performance. So comparing accounting data over the years can lead to misleading assumptions, since the data will not be affected by inflation, so raising or falling in prices. So different companies may use different accounting approaches, and so will have different ratio results, making comparisons between companies unreliable. Great stuff. Well done for watching this video, because this will definitely help you get the A star you really deserve. So now it's question times. If you have any question, please make sure that you comment them in the section below, and I will be more than happy to answer them for you. But I need you to answer these 5 questions, because if you don't, it will be pointless watching these videos, because it's these questions at the end that help you remember things. So what I want you to do is to comment down below answers to all these 5 questions, and I will personally mark it for you. So I want you to list one profitability and one liquidity ratio with its formula. I want you to explain what is analysis of account. I want you to explain or list one internal and one external users of account, state why and how they use the accounts, and then I want you to give me 2 disadvantage of ratio analysis, and I want you to explain why is profitability ratio important. Please make sure that you answer these questions, because without these questions you will not be able to remember things very well. So make sure you answer these questions in the comment section below, and I will see you on the next video. Also make sure you visit my website, because there's tons and tons of information there.